Thank you for watching this webinar, which will cover a technical accounting update. Before I begin, I wanted to briefly introduce myself. My name is Bayan Aliyar and I'm the Technical Assistant Manager here at Menzies. I started my accountancy career at Deloitte in the audit department for 1 year before moving to Menzies to join the technical team as a technical senior in 2017, where I then qualified in December 2019 and have been with the technical team at Menzies for 3 years. Today's webinar will cover several topics. Firstly, I will be providing a refresher on going concern, which is something that continues to be a major topic, particularly as a result of the effects of the pandemic. Next, I'll be covering some of the changes to Companies Act that have occurred following Brexit. And finally, I'll be providing a reminder on accounting for share options under FRS 102, which often is viewed as a challenging area in practice. Many companies have been adversely impacted by COVID-19 and the effects of government restrictions introduced to reduce the spread. My colleague Miriam in the previous September 2020 CPD update has covered the financial reporting implications of COVID-19 in detail, and this webinar is available on our website. But one point I did want to re-emphasise was around going concern, as this is something that is particularly an issue with the pandemic and continues to be a major topic. So when it comes to going concern and preparing accounts, there are two considerations we need to be thinking about. Firstly, is the going concern basis of preparation appropriate for the entity? So financial statements should be prepared on a going concern basis unless management intend to liquidate, cease trading, or have no realistic alternative but to do so. And in assessing whether the going concern assumption is appropriate, management takes into account all available information about the future, which is at least but not limited to 12 months from the date when the financial statements are authorised for issue. The point I wanted to make on this is that it's quite rare for accounts to be prepared on an alternative basis or not on a going concern basis. And virtually in all cases when you do see this, it's because the entity has already ceased or there is a plan to cease. It is very unusual to have an entity that hasn't ceased or there are no plans to cease, but also recognises that there is no realistic alternatives but to cease. As even if, for example, we have a company experiencing significant cash flow difficulties, there will often be realistic alternatives, and therefore it will still be appropriate to prepare financial statements on a going concern basis. And this then leads me to the second point. So after assessing whether the company is going concern, you then need to be considering whether there are any material uncertainties related to events or conditions that cast significant doubt upon the entity's ability to continue as a going concern. So if as part of management's going concern assessment, it is concluded that there are material uncertainties, then these will need to be disclosed. And this is something recently we've seen a lot more with companies disclosing material uncertainties, particularly as a result of COVID and the uncertainties that have arisen as a result of this. So a potential indicator that there may be a material uncertainty is for those entities where, for example, we have a negative balance sheet, as this can mean we may have a situation where you're unable to meet debts when they fall due, and that's the uncertainty element. It may be, in fact, that the case is that we have a negative balance sheet, but actually the company are very well supported by the parent company who have the financial ability to support the subsidiary company and are willing to do so, in which case it wouldn't be a material uncertainty. But if we have an example whereby the company has applied for additional borrowings to provide working capital, but the outcome of these applications is yet unknown at the point of signing, then this creates an uncertainty and will need to be disclosed as a material uncertainty. In terms of disclosure and what you need to disclose for going concern, if the accounts are prepared on an alternative basis, so the accounts are not on a going concern basis, then this needs to be disclosed. Or as mentioned, if there is a material uncertainty relating to going concern, then this must be disclosed also. If we determine that the going concern basis of accounting is appropriate and there are no material uncertainties, then there are technically no specific disclosure requirements required for the financial statements. But in the scenario I talked about, whereby, for example, you have a negative balance sheet but are supported by the parent company who are in a strong cash position, then you may want to provide additional disclosure for this for a true and fair view, as this will be something that is useful for the users to understand. So moving on to Brexit, as I'm sure you're aware, the UK formally left the EU on the 31st of January 2020, which does seem quite a long while ago now, but we continue to be in the transition period up until the 31st of December 2020. The end of the transition period brings into effect certain changes in company law. Most of the substantive changes to company law requirements are applicable for financial years beginning on or after the 1st of January 2021, so will impact December 21 year ends onwards. So I wanted to cover these briefly over the next few slides so that you are aware of some of the practical changes these may have for your December 2021 year ends, so that you are considering these in advance. One of these changes is in relation to qualifying as a small entity. So currently, if a company is below the small company thresholds, if they are part of what is called an ineligible group, they then still are unable to apply the small companies regime and take advantage of some of the simplified requirements and exemptions available for small companies. An ineligible group is basically a group of companies that includes certain companies that meet specific criteria. And previously, one of the criteria for an ineligible group was one that included a company or a body corporate whose shares are admitted to trading on a regulated market in an EEA state. Following Brexit, the reference has now changed to a UK regulated market, making the definition less restrictive. So for example, whereby previously if we had a UK subsidiary that in all other respects qualified as small, but it had a German listed parent, previously it couldn't apply the small regime, as by having a German listed parent, it meant it formed part of an ineligible group. But for periods beginning on or after the 1st of January 2021, however, this would no longer make the group ineligible. The next change I wanted to discuss was around intermediate parent consolidation exemption. If you are an intermediate parent company, so you have your own subsidiary, but you also have a parent company, then conditional upon meeting certain requirements, you could get an exemption from preparing consolidated accounts. And previously, Section 400 of the Companies Act applied where you had an EEA parent. So you may be thinking that again, if you have a German parent and you've previously taken that consolidation exemption under Section 400 of the Companies Act, are you still eligible to take this exemption following Brexit? And the answer is yes, you still can, as a similar exemption contained in Section 401 of the Companies Act, which was available previously whereby you had a non-EEA parent for periods commencing on or after the 1st of January 2021. This Section 401 has been expanded to include groups with an EEA parent. So in terms of what this means as a practical application, this means for accounting periods beginning on or after the 1st of January 2021, rather than using Section 400 reference, you would be using the Section 401. So you still won't need to prepare consolidated accounts, but you just would need to make sure that in your accounts, for where you disclose why you're not consolidating, that you are referencing the right section number of the Companies Act. Another change I wanted to mention was around dormant subsidiaries. So dormant subsidiaries are not required to prepare or file individual accounts for a financial year when certain conditions are met, including the existence of a statutory guarantee by the parent of all the subsidiaries' outstanding liabilities at the year end. Prior to the amendments of Brexit, the parent giving the guarantee had to be incorporated in an EEA state. This has now changed to the parent being registered in the UK, making the exemption more restrictive. So, for example, a dormant subsidiary of a German parent would be entitled to take this exemption, but for accounting periods beginning on or after the 1st of January 2021, this exemption will only be available for subsidiaries of UK parents. So in this case, you would have to prepare accounts for your dormant subsidiaries. So that's just something worth considering as to whether this affects you for the upcoming December 2021 year ends and onwards. The final change I wanted to mention was a change to the subsidiary audit exemption, which is a Section 479A exemption. This is where there is an exemption for audit if you have a parent guarantee, and prior to the amendments, the parent providing the guarantee had to be incorporated in an EEA state. For periods commencing on or after the 1st of January 2021, this has now changed to the parent being registered in the UK. So if you had a subsidiary that was previously exempt from audit because their parent was in the EEA, this may now require an audit for your December 2021 year end. So this is definitely something worth checking whether or not this affects you so that you can prepare in advance. So that concludes everything I wanted to cover on Brexit in terms of the Companies Act changes. Some of these changes can be quite confusing, so I've tried to cover off the main ones. But if you are unsure on any of the changes I've covered today, please feel free to contact myself for these for more detail. So we have covered some of the more topical issues with regards to both Brexit and COVID-19, but the last area I wanted to cover is share options. You may be wondering why I'm covering this, as there hasn't been any recent changes in this area, but this is a tricky topic that people seem to struggle with in practice, so I thought it would be helpful to provide an overview of the accounting treatment for this. Many companies choose to incentivize and reward employees by issuing them with share options as part of an equity-settled share-based payment arrangement. And in terms of what a share option actually is, this is something that gives the holder of the option the right to subscribe for the company shares at a fixed or determinable price for a specific period of time. So for example, an employee may hold a share option which entitles them to purchase a share of the company for £1 between the 1st of July and the 31st of December 2021, regardless of the company's share price at that time. In terms of accounting for share options, all companies reporting under FRS 102 are required to account for the award of share options as part of an equity-settled share-based payment arrangement. This means that even a small company reporting under FRS 102 Section 1A will record the accounting entries for this. When accounting for share options issued as part of an equity-settled share-based payment arrangement, it is the fair value of the share option at the grant date that needs to be determined. And the grant date is the date on which the company and the employee agree to the share option agreement. FRS 102 sets out how to measure the fair value of share options using a 3-tier measurement hierarchy as shown on screen. And it is the element of valuing share options which is commonly the most challenging area in practice. For many listed companies, they are more likely to be issuing options on a frequent basis and market data is readily available. But for the majority of private companies and most entities applying FRS 102, then only very few of these will have an observable market price for their shares or a recent transaction in the entity shares. And so in the majority of instances where market data is not available or not readily available, it is likely that a specialist will be required to assist in calculating the fair value using an option pricing model such as the Black-Scholes model. This takes into account a various number of inputs, such as the share price, the exercise price, dividend yield, and expected life of the option. One common misconception around valuing share options is that the share price is the fair value of the option, but the share price is the price of one share of the entity. This will vary over time and is different from a share option. As such, the fair value of the share is not the same thing as the fair value of a share option. Once the fair value of the share options issued at the grant date has been determined, this is recognised as an expense in the profit or loss with a corresponding increase in equity. If the share options vest immediately, i.e. there are no conditions attached and the employee is immediately and unconditionally entitled to those share options, then the expense is recognised in the profit or loss account immediately. In situations, however, where the employee is required to complete a particular period of service before becoming unconditionally entitled to the share options, so for example, an additional period of 3 years from the grant date, then the expense is recognised over this period, and this charge is then adjusted each year to reflect the number of options expected to actually vest. And finally, one final point I wanted to mention is around share options and the disclosure requirement for these. This can often be a tricky area, and often it is the case that with share options, we can see insufficient disclosures in the accounts around these. So as a reminder on the disclosure requirements, for companies who are reporting under FRS 102, companies must adhere to the extensive disclosure requirements of paragraph 26.18 to 26.23 of the standards in relation to share-based payments. This includes disclosure of information around the nature and general terms and conditions of the share-based payment arrangement. And for equity settled share-based payment arrangements, how the entity has measured the fair value of the equity instruments granted. Additionally, an entity is required to disclose the number and weighted average exercise prices of share options for several groups, including those options outstanding at the beginning of the period, options granted during the period, and exercised during the period. There is also a requirement to disclose the total expense that has been recognised in the profit and loss for the period in respect of share options. For entities applying FRS 102 Section 1A, there are no explicit requirements for disclosures relating to share options. However, the accounts must nevertheless provide a true and fair view, and it may be decided, therefore, that disclosure is required to achieve this. So that is everything I wanted to cover on share options. And as I mentioned, this is an area that most people do find challenging, particularly around determining the fair value of the share options. And in these instances, it may be beneficial to speak with a specialist to assist in calculating the fair value using an option pricing model such as the Black-Scholes model. Thank you for listening to today's technical accounting update. I hope you have found this informative and useful. It may be that you do have further questions as a result of the webinar, and if that is the case, then please feel free to contact myself or one of your contacts at Menzies, as we're always happy to help.